Welcome to This Explainer. If you've been watching the financial world lately, you've probably felt this creeping sense of confusion, right? It's high energy, constantly moving, but honestly, beneath the surface, it feels totally disconnected from fundamental reality. So let's dive into exactly why the stock market feels so completely broken right now, and, more importantly, we're going to ask the big question: could this strange new reality actually be permanent?
Okay, let's get into this. Sometime over the last few years, a massive shift happened. Investing just stopped feeling like actual analysis. Looking at the boring adult stuff, cash flows, earnings reports, economic data. Instead, it started feeling a whole lot more like a chaotic game show. It's literally like watching a game of Wheel of Fortune where the wheel just keeps spinning, the prizes keep getting bigger, and the whole thing is completely untethered from any underlying value.
Section 1. The Capitalism Speedrun. We have officially entered a phase in the market that, frankly, borders on the absurd. You've got thousands of people on platforms like Reddit treating investing entirely like a video game, and their goal, it isn't long-term wealth accumulation. No, it's to beat the game as fast as humanly possible. I mean, look at this, 2,000%. Honestly, it's hard not to smile when someone on a forum turns a weekly options trade into a massive 2,000% gain, and then immediately posts a screenshot of their phone like they just unlocked the capitalism speedrun. But while it might be wildly entertaining to watch from the sidelines, it perfectly illustrates the intense manic haze we're in right now. Because, for most of modern financial history, markets weren't perfect, but they were at least anchored to something real.
And history tells us that markets have always had these periods where they go through wild, manic phases. We can look at large-cap stocks in the 1970s, the massive explosion of internet stocks in the early 2000s, or the banks leading up to 2008. There was always speculation. But the absolute key takeaway here is what happened at the end of each of those timelines. Eventually, fundamentals showed up, like gravity. You could ignore those fundamentals for a while, you could mock them, post memes about them, whatever. But sooner or later, intrinsic valuations always returned. There was this core, unspoken belief that value investing was the rock-solid foundation.
Which brings us to Section 2, the death of fundamentals.
What feels so profoundly different this time around is that the old rule of market gravity seems suspended. The relationship between market prices and actual business fundamentals is completely fractured. It's like they're technically standing in the same room together, but they are absolutely no longer on speaking terms. And this metaphor really hits the nail on the head. Bringing up fundamentals today gets the exact same reaction as asking the club DJ to play Nickelback. I mean, you're just going to get laughed out of the room. The 2020 pandemic wasn't just a temporary shock to the system, it fundamentally rewired the long-term investing mindset. The old story was all about buying quality companies at fair prices for the long term. The new story? Just buy the dip because stocks only go up.
So how did we get here? Well, we can trace it back to a three-step perfect storm in 2020. Step 1, a massive influx of new retail investors entering the arena, stimulus checks in hand. Step 2, interest rates dropping to historic rock-bottom lows. And Step 3, Jerome Powell and the Federal Reserve running the money printer like a fire hose. Together, these three catalysts slowly but surely took buy the dip from being just a strategy and transformed it into a really dangerous underlying assumption. Literally, every sell-off simply became a guaranteed buying opportunity.
And this shift isn't just affecting enthusiastic retail traders on their phones. It is completely breaking the models of seasoned Wall Street professionals. Take Michael Burry. This is the legendary investor who famously made $800 million betting against the 2008 housing market. He's basically the human embodiment of trusting the fundamentals. Yet he recently shut down his hedge fund. And this quote is telling. He said, "My estimation of value in securities is not now and has not been for some time in sync with the markets." Wow. When the market can stay irrational longer than you can stay solvent, traditional experience stops being an advantage, it actually becomes a liability.
Section 3. Enter behavioral finance.
Now, this paradigm shift forces us to ask a really crucial question. If those old-school fundamentals, the cash flows, the earnings, if they aren't driving prices anymore, then what exactly is the hidden force moving the market? Well, this completely flips traditional finance on its head. Traditional finance assumes markets are efficient, perfectly rational. But behavioral finance starts from a very different assumption. It assumes markets are human. It assumes that things like greed, fear, human psychology, and our ingrained biases are the actual true drivers behind market behavior.
Think back to the pioneering discoveries of psychologists Daniel Kahneman and Amos Tversky back in the late 1970s. They proved that we humans absolutely do not evaluate risk objectively. We fear losses far more than we value equivalent gains. We firmly anchor ourselves to compelling narratives, and we instinctively follow the herd. Now, for decades, despite all this evidence, traditional investors kind of just dismissed these psychological findings. They kept behavioral finance on the fringes, treating it as just a convenient way to explain occasional market anomalies, like, why a temporary panic or a rare bubble might form.
But this illustrates a massive shift we've undergone since 2020. Before, the traditional investor asked, what is this company's intrinsic value? Today, the post-2020 investor asks, how will people react to this news? Behavioral finance went from being a fringe theory used to explain weird edge cases to literally the actual operating system of the modern market. When narratives matter more than balance sheets, momentum overpowers valuations, and prices move entirely independently of the underlying math.
Moving on to Section 4, the social media accelerant.
If human psychology is the fire, the modern internet is the gasoline. Human behaviors like herd mentality and recency bias, they've always existed. But look at how friction has totally collapsed today. Information moves instantly. Narratives don't take months to spread through stuffy financial newsletters anymore. They spread globally in hours. I mean, you can wake up, see a hot stock tip from a random guy on Twitter, and deploy capital straight from your phone before you've even finished brushing your teeth. The distance between information and reaction is literally zero. It moves so fast. It's gotten to the point where even massive Wall Street institutions have been forced to adapt. Instead of just modeling cash flows, they are out there scraping the dark corners of Reddit at 2 a.m. for sentiment analysis. Why? Because online narratives do a better job explaining price action than traditional metrics. Crazy, right?
Section 5, Bubble or New Regime.
Let's slow things down for a second and look at the ultimate mystery we're facing right now. We know the market is behaving strangely. We know fundamentals have taken a back seat to sentiment. But is this just a passing fad, or are we witnessing a permanent structural shift in our financial ecosystem? We're essentially looking at two possible realities side by side here. On one hand, we have the argument for a familiar bubble. This side says that yes, psychology has taken over temporarily, prices have drifted far from reality, but eventually history is going to repeat itself and gravity will return. But on the other hand, we have a very hard-to-ignore argument for a new regime. This argues that the absolute absence of friction, the rise of social media, and the massive influx of new retail investors means we've undergone a structural shift. In this reality, markets no longer price cash flow, they literally price attention. This is the massive philosophical divergence we're living through right now, and honestly, there's a very strong case to be made for both sides.
So I'll leave you with this final provocative question. Is this simply a temporary bubble driven by familiar human psychology, or is this a permanent shift in how markets fundamentally work? It's a fascinating mystery to ponder as we sit here watching the numbers flash red and green every single day. And well, there's a certain irony here at the end, isn't there? The very act of us debating whether this is a bubble or a permanent regime, that might just be part of the exact same human psychology that's driving the whole thing to begin with. Thank you for joining me for this explainer. I really hope it provided you with a clear, structured lens to view today's chaotic market through. Keep observing, keep questioning, and I'll see you next time.